Today is all about data. We're going to talk about curve fitting and overfitting, what it is, what it means, and how you can avoid it. Welcome back to the show, guys. My name is AKIL'S, host of the Trading Coach Podcast. Thank you as always for joining. This is another video edition, so make sure you join on YouTube or Spotify. Speaking of Spotify, I've been digging through the data, and it's cool to see that traders from over 120 countries have enjoyed the Trading Coach Podcast, which is awesome. And from the bottom of my heart, I just want to say thank you, merci, gracias, danke, Cici. That's all I know, and I apologize if I butchered any of those. But today we're talking about curve fitting, and this was a recent subject that I had a conversation with one of the traders on our platforms. We are in the month of December. This is the time where the markets aren't really too exciting anymore. I always encourage traders, stay away. There's no need to be trading around Christmas and New Year's. Just wait for the new year to begin and rather spend this time doing the things that are going to help set you up for the new year of trading, whether it be data review, whether it be continued education. For a lot of traders on our platform, it is backtesting. They have time off from work and they can spend countless hours in front of the computers analyzing and inputting data. Fun stuff. Seriously, there are some sickos out there that enjoy it. You weird people, you. Backtesting for me was always an enjoyable part in the beginning and the end. I love the beginning. I'm all fired up and excited to dig into a new strategy and test the numbers. Then in the middle, it becomes like a job and a chore, and I'm like, blah, 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 blah. Then at the end, I'm excited again because I get to crunch the numbers, and typically if I make it to the end, it means that the strategy is pretty profitable. So I'm excited about actually taking something, getting the proof I need, and being able to trade it live. Now, the topic that I was talking to with this trader was the topic of curve fitting and or overfitting. You'll probably hear it in different types of ways. And I want to explain what that is to you guys. So curve or overfitting, whatever you want to call it, is pretty much the process of manipulating data so it shows you what you want to see, right? Sometimes it's purposeful, sometimes it's not purposeful. We'll talk about that in a little bit. But pretty much you're over-optimizing this data for a very specific reason, and that very specific reason is typically to make as much money as possible, or to show that a system or a strategy can make as much money as possible. So why does this happen? Well, we'll start off with kind of the sleazy way. So a couple podcast episodes ago, we told you about copy trading and what that is, and signal services and stuff like that. So imagine that someone is selling you a program to trade, or someone is selling you a signal to follow, or trades to copy, some type of service where you're either taking what they've created or you're following what they created. And in order to intrigue you to do that, they're making it look good, right? So imagine if I'm trying to sell you a trade copy service and I had a system or strategy. I'm sharing with you the data and the numbers because you want to see that type of stuff. If I had one that was like, meh, it was okay, average, nothing like wooey and wowie, which remember, that's typically traders that are doing those type of services. They're looking for the woos and the wows, right? Versus a strategy that was like incredible, right? You're going to go with the incredible strategy. And the question is, well, how do I get these numbers to be so incredible? How do I get these numbers to look so much different than what typically is out there? No, that's not typically out there on the internet, because typically what's out there on the internet is these wowie numbers. How do I make these numbers look different than what real traders, professional traders, honest traders are producing? Well, the answer is I manipulate these numbers to only show the part that performed optimally. So I can give you a real-time example right now, right? I ended the last 3 weeks of my trading year on fire. Pretty much after Thanksgiving on till second week of December, second week of December, right? I was on fire. Massive returns, big strike rate, much higher than what I would normally produce during like a bigger sample size as far as like win percentage and return on investment, like within that time. So imagine if I was someone trying to sell you a signal or a service, right? Instead of showing you my results over the entire year and being like, hey, this is what my system produces, I'm going to take that small sample size and I'm going to be like, hey, the AKIL'S strategy, the ASS, oh no, Well, yeah, that'd be oh gosh, I didn't even do that on purpose. The ASS strategy, right? Sorry. Live podcast. The AS. All right, get it together. Come on. Ooh, right? Wolf of Wall Street, right? The ASS strategy produces 25% return on investment with an 80% hit rate in just 2 weeks, right? Because technically I did that in 2 weeks. It wasn't quite 25%. I don't know what the number was. I haven't added it up yet, but you guys get the point. Although it's not a lie, because I did have that type of hot streak in 2 weeks. Again, not 25%. It was lower than that. I think it was more like 10%, 12%, something like that. But the truth of the matter is, right, although I did do that in that 2 week period, is that the proper expectation for every 2 weeks throughout the entirety of the year? No, it's not. But that's how you kind of lie without lying. It's like one of those commercials that come on TV where they sell you this pill, and it's like, this pill is magical. And then it's that very small print at the bottom where they're reading really fast, and like, it may not actually cure. We're surrendering to cure, right? And they're not lying, but they're kind of not really telling you the full truth. So people that are selling you systems and services, or even like portfolio managers to a certain extent, sometimes they do this curve fitting with their strategy, on bigger than a 2 week sample size. That was just an example, but to kind of intrigue you to buy their product on kind of false pretenses or not the whole truth. So you got to be very careful of that. That's why they do it. Now, why do we do it? Well, sometimes subconsciously we do do it purposely. Why would we do that, Akil? Well, the answer is this. I told you about the glorious period of backtesting, right? We are excited. We got into trading. We are testing a strategy. We want it to perform good because if it performs good, the next step is trading it live. And if it trades live, we can make money, baby, right? So we want it to do good. However, right, when we go through that backtesting process and we start and the numbers start to not look as good as we thought it would, we start doing things to create better numbers. So sometimes we do the same thing as a sleazy salesman where we only kind of take a good sample size. If we're testing over a 10-year period and let's say the first 8 years were good and the last 2 years were bad, sometimes traders will be like, I did get 100 trades before those last 2 years, so I'm just gonna not look at them. And hey, during this 8-year period, it was amazing, right? We're purposely ignoring the bad periods of time. Or sometimes we're adding too many filters or adjusting our filters, meaning this, right? We want to test our data over our trading strategy, over different time periods because we want to see the fluctuations in it, right? Market conditions change. I'm not going to go over all the ways they change, but trust me when I say they change. I've been doing this for 18 years and I've witnessed it firsthand. A little bit of a surprise when I first noticed it because no one told me that they changed. So I kind of went right into the snowstorm, but over the years, I've learned to grow, adjust, and adapt and kind of handle those situations. But we want to test our trading strategy over different market conditions because it is going to perform differently, right? Sometimes it's going to perform really, 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 really good. Sometimes it's going to perform meh. Sometimes it's going to be in a drawdown. And we want to make sure that our strategy can kind of withstand all of those conditions. However, what some traders will do is they will make adjustments, right? During the great periods, they will let the strategy be, right? The rules are the rules. It is what it is, right? But then during those kind of rough periods or not so good periods, they'll notice that it's not performing good. So they'll start adding filters, right? They'll say, okay, well, if I add this or if I do that or if I do this to bring the performance level from here back up to here. The problem is they're not doing that for the whole sample size. They're only isolating the rough years. And you need to know if those adjustments would play a role with the good years as well. So let's say this, for example, let's say you're a trader that's making an adjustment from an aggressive entry to a more conservative entry, right? So an aggressive entry is like you see the signal, you get in right away. A more conservative entry is maybe you need an extra signal or whatever to get involved. Well, maybe adding that extra signal during that rough period of trading, right? That saves your bacon. It keeps you out of a lot of bad trades. It puts you in better trades. It ups your win percentage. It ups your return on investment. You're back, baby, running at full cylinders, right? But if you were to take that same less aggressive approach with the period that did good, would you still catch all of those trades? Would you miss some because you're not as aggressive? Would those performance stats still be the same, or would they be lower, right? So when we're making adjustments in our strategy, we have to make sure to do it over the entire sample size and not just the pieces that we want to fix. And that's a problem that I see a lot is we'll have that big sample size. We'll say, hey, year 1 through 5 was great. 5 through 8 was meh. And 8 through 10 was great. Let's go in and figure out how to fix 5 through 8, not thinking about the consequences of the other two. Another thing that traders do is adding too many filters. This isn't necessarily curve fitting. Maybe if you're a quant trader and you're running something on a kind of a mechanical backtesting thing, yeah, that can be in the case. But too many filters can kill all your trading opportunities. I remember we had a meeting, a live meeting, where we had a trader that was coming in. He was a brilliant trader, one of the smartest minds I've ever met. And he developed this strategy that was like 99% correct. The problem was, and that was his goal. His goal was, how can I optimize my trading strategy so that I do not lose? And the problem was that he added so many filters that this strategy only gave 2 valid signals a year. So 1, is 2 valid signals a year worth it, right? And 2, think about the fear you would have, right? If you have only 2 valid trading signals a year, you never know when these signals are going to come, right? It's not like day trading where it's like, hey, I'm going to get maybe 50 opportunities a month. So if I miss one because I overslept or I'm sick or whatever like that, no big deal, right? The law of large numbers will kind of even itself out. If you have 2 and you miss 1, right, you're out of luck. So it was a good idea of optimization of a strategy, but it wasn't realistic in how you can trade it. So again, not the same as curve fitting, but you see that a lot with a lot of these kind of quantitative automated systems where they're plugging in numbers and they're doing so much to optimize the strategy that it's not realistic. Another problem on the quant side of things where it comes to like optimizing strategies is that they don't take all the real life stuff into account. I guess this can be in discretionary trading as well. I remember that I built a strategy on the range bar chart once. We're thinking about a really lower time, a really small time frame. So something equivalent to like the 5-minute chart where it was giving really quick signals. What I didn't take into account were spreads, commissions, fees, slippage, stuff like that, and also kind of speed of execution. Long story short, when I backtested it, here we go. I almost made it through a podcast with correct words, and I went and stumbled over myself there. Probably shouldn't have said anything. You wouldn't even have noticed. Maybe I'll go back and delete it. It will never have occurred, right? All right, so now that error has never occurred, darn it, now I just admitted it. I'll leave it in. Anyway, so what I did with this range bar strategy was, it was good during backtesting. It checked all the boxes, and full disclosure, because it was on range bars, I couldn't backtest it as much as I wanted to. We just don't have that type of reliable data when it comes to the range bar charts. But realistically, or back to the story, the trading strategy wasn't realistic. It worked in backtesting where everything was slow and controlled and worked out perfectly. In real life, it didn't, just because of a small measure of difference. The difference between the slippage that I was taking on every single trade was the difference between a profitable and a non-profitable strategy. So something that small can have a massive difference. This reminds me of, I was going down this hole yesterday. You guys ever heard of 3-body problem, right? I think it's a Netflix movie as well. But in space and the universe, right, there's something called the 3-body problem, where if you have kind of 3 planets or 3 things of big masses and they all kind of go into each other's gravitational pull, they will basically destroy each other and cause chaos and blah, 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 blah. And I was reading up on this the other day about scientists. This is a problem that is unsolvable. And the reason that it's unsolvable is because, yes, they can put together all these scientific equations using their supercomputers and whatnot. But there's one thing that's not taken into account, and that is kind of the randomness. And the randomness that can change something by the slightest will change the entire equation, right? I gave this example whenever we talk about 1% degree of change, where imagine like you're standing where you are, right? And you walk straight forward to a wall, right? Take 10 steps forward, put a dot on the wall. Now go back to where you're originally standing and then just move yourself a little bit, like 1 degree to the right, and then walk 10 steps forward, and you'll see that dot on the wall that you mark is in a different place. Now imagine if you did that between, instead of walking 10 feet or 10 steps to a wall, if you walked 10 miles forward and you walked and then you change yourself by 1 degree and walk 10 miles forward that way, all of a sudden your original path is here, your new path is all the way over there. So there's these small random occurrences in the market, or small things that we don't take into account in backtesting, that can end up having massive effects on our strategy when we trade it live. And that's why, although backtesting are the best proof, the best data that we can get to see if something works, it doesn't take into account necessarily the full randomness of the markets. In a way it does, because there was randomness in the markets when we back tested it, but we never know what the future will hold. So we never know what the new randomness will be. This is a whole different place than I wanted to go to. I apologize. So let's get back on track. So let's talk about the solutions to this, not the 3-body problem, Akil. I don't know that. Let's talk about the solutions to this curve fitting. And it really comes from within. Honestly, what you have to do is accept imperfection. I know we want the perfect trading strategy. I know we want a 100% win rate. I know we want all of the return on investment in the world, but it sounds weird saying this, you have to settle. You have to accept the markets, the fact that the markets are imperfectly perfect, and your trading strategy and you as a trader, it's not meant to capture everything. It is meant to get specifically what it's meant to get, and that's okay. You can still be a very good trader, right? You can trade your strategy and optimize it and kind of get as much as you want out of it. You can trade your strategy and then add other strategies to kind of maximize your whole portfolio of trading, just like an investor. The key is you have to play the long game. There's no shortcut of like super secret magic strategy that will work right away. Rather, the goal should be good enough with your strategy, consistently trade it and extract profits from the market, and then continue to compound your account, because that's where the real money comes from, doing the same thing with bigger size. Speaking of size, we've been doing our best to grow the size of our community here at the Trading Coach Podcast, but I need your help to keep it going. So here's what you can do. 1, leave me a rating or a review if you haven't done so already. 2, make sure you share this with your social community. You can share your Spotify Wrapped. You can share this specific episode. You can just share like, hey, if you're looking for a podcast to listen to or watch, check this guy out. He's pretty cool. The more traders we can bring into our community, the more cool topics we can discuss. I've been doing these episodes every day or 5 days a week, so I want to keep the good content flowing. If you can do that, I will be grateful. Until next time, plan your trade, trade your plan. Take care.